$260 billion. Guys, that is how much market value Nvidia lost this week alone. Not this year, not this quarter, this week. And yet, if you look at what institutions were actually doing during the sell-off, they weren't running for the exits, they weren't downgrading the company, and they weren't cutting targets. In fact, some of the largest pools of capital in the world were committing fresh money to AI infrastructure projects built around Nvidia. Guys, my name is Luke, and this is the OptionBomb, and today I want to show you what really happened this week with Nvidia. Because it wasn't really a story about Nvidia, the company. It was a story about inflation, oil prices, interest rates, and why retail traders keep confusing macro volatility with fundamental weakness. So let's get right into this. So before we talk about the sell-off, right, going from 230 some odd dollars to below the $200 mark, let's talk about what institutions were doing, because that is the signal we actually need to look at. Everything else is just noise. So this week we learned that KKR, Nvidia, Vistra Energy, and the Kuwait Investment Authority are committing more than $10 billion to a project called Helix Digital Infrastructure. So think about who we're talking about here. KKR, a sovereign wealth fund, massive infrastructure investors. These are organizations that deploy capital on 5-year and 10-year horizons, and they are building more AI compute infrastructure, not less. And that tells us something very important. The people managing $100 billion portfolios are not changing their Nvidia thesis because of a CPI data print. They're expanding it. And while that was happening, guys, Wall Street analysts were doing something else. They were raising price targets. Current analyst consensus sits at approximately $298 per share. And that's 38 analysts. Strong buy ratings, about 46% upside from current levels. So while retail was panicking over a 4% decline, institutions kept their eyes on the target and were continuing to build. Analysts were upgrading. And that is the first clue that this was not a fundamental sell-off. So now we need to ask the most important question here. Did anything actually change at Nvidia this week to cause the sell-off? Right? Did they miss earnings? No. Did they lose market share? No. Did they lose a major customer? No. Did Blackwell guidance get cut? No. You sensing a trend here, guys? Right? Did demand for AI infrastructure disappear? Absolutely not. In fact, Nvidia continues guiding toward expanded Blackwell shipments through the second half of 2026. The AI build-out is still happening, right? Microsoft, Google, Amazon, Meta. Those are big companies, and they're buying Nvidia products. And all of those 4 companies, the biggest companies in the world, are continuing their aggressive spending on AI infrastructure. And Nvidia remains the primary supplier, right? That is not changing. So if the business didn't change, why did the stock drop? That is where the macro story comes in. Nvidia didn't sell off because of Nvidia. It sold off because of inflation. And inflation moved because of oil. And oil moved because of Iran. That's the chain reaction. And understanding that distinction is one of the most important investing skills you can ever develop. This week, the market got hit by a combination of factors. First, last Friday's stronger than expected jobs report reinforced the idea that rates could stay higher for longer. And we are going to see Kevin Warsh lead his first ever Fed meeting next week. Then, guys, the CPI came in at 4.2% year over year, the hottest reading since April of 2023. Energy costs up 23% year over year, pretty much thanks to the price of oil in Iran and the Strait of Hormuz, right? And that's where that's where they cited much of the pressure came from. So here's what the market interpreted all this as: higher inflation, higher rates, longer Fed pause. And when investors get nervous about rates, growth stocks get sold, especially mega cap tech names, right? AI stocks, Nvidia. So that is what happened here. Not a company problem, a macro problem. And those are very different things. So now let's walk through the timeline here, guys. Friday, June 6th, market sold off broadly. Strong jobs report. Semiconductor weakness elsewhere in the sector. Nvidia gets dragged lower. Tuesday and Wednesday, CPI comes in hot, 4.2%. Rate fears accelerated. Nvidia continued falling. By midweek, the stock touched 199. It broke 200, down from 232, I think was the peak that I was looking at. So at the trough, roughly $260 billion in market value had evaporated. And then Thursday happened. Fresh discussion around a potential Iran peace deal. Oil prices plummeted. Rate sensitive names rallied. Nvidia bounced sharply, right? Heading into Friday pre-market, the stock is sitting around $205, up approximately 1.1%. So in roughly 4 sessions, 260 billion disappeared. And then the recovery started almost immediately. So this is where most retail investors make it, me and you, this is where we make our mistakes, right? We see the red candles and assume something is wrong. But markets don't always sell stocks because the business changed. Sometimes they sell stocks because fear changed. And those are not the same thing. When a fundamentally strong company gets hit by macro pressure, the earnings power has not changed. The moat hasn't changed. The customers haven't changed, and neither has the demand. Only sentiment. And sentiment eventually normalizes. And that's why macro-driven sell-offs in quality companies often become opportunities rather than warnings. And the people who understand that distinction tend to accumulate. The people who don't panic. And now, guys, let's talk about the chart. A few things stand out here. First, the 199 to 200 zone, it held. We can see a couple wicks down here. We hit that 199.54, bounced back up. Now we're at 204.35, right? The buyers showed up immediately at this level, and that's important because support isn't just a line on a chart, right? It is evidence that investors want to own the stock at a particular price. And this week, they said, all right, $200, that's the price. Second, guys, look at the speed of the recovery. The bounce happened quickly. It tried twice. It tried on this massive red candle right here, and it tried again over here, and it, boom, right? Couple green candles straight back up. And that is common in these macro-driven sell-offs because once the fear subsides, there's no company-specific reason for sellers to stay aggressive. And third, guys, the market is heading into the June 17th FOMC meeting, expecting no rate change, right? So a hold will remove uncertainty. Historically, growth stocks often respond positively when the market receives confirmation rather than speculation. Now, that doesn't mean Nvidia goes to 300 next week, but it does create a constructive setup. So now, that's the macro. For those of you who trade options, I have a few observations for you. Nvidia earnings aren't until August, and that is important because elevated implied volatility right now isn't being driven by the earnings. It's being driven by macro uncertainty. The CPI, Iran, rates, the Fed. That's a different environment than pre-earnings setup. So the next major catalyst is going to be June 17th. That's the FOMC decision. The market expects them to hold rates steady. If that expectation is confirmed and the tone is less hawkish than feared, growth names could continue recovering. For traders looking for bullish exposure with defined risk, this is the type of environment where a call debit spread becomes interesting. You're participating in the upside, but you're controlling risk if the macro picture changes. So as always, guys, this is not financial advice, just how I'm evaluating the setup. So here's what I'm watching next in this name. Over the next 60 days, there are 4 things that matter. Number 1, the June 17th FOMC meeting. Watch the language, not just the decision. Number 2, Iran in the Strait of Hormuz. This remains the macro wild card here, right? Does it open? Does it close? Do tensions ease, rise, right? That is what we don't know for sure. Anything could happen with those guys. Number 3, Blackwell shipment updates. Any change in delivery timelines will move the stock. And number 4, August earnings. This is the real test. The market wants proof that Blackwell demand continues translating into revenue and guidance upgrades. So guys, here's the bottom line. Nvidia lost 260 billion in market value this week, but the company didn't lose its leadership position. It didn't lose demand. It didn't lose customers. It didn't lose the AI infrastructure cycle. What changed was inflation expectations, oil prices, rate fears. That's it. Meanwhile, institutions committed more than 10 billion to new AI infrastructure. Analysts maintain a strong buy consensus, and the long-term AI build-out is fully intact. The market gave investors a discount because of a geopolitical headline. And whether that's an opportunity or a warning depends entirely on whether you understand the difference between macro noise and fundamental signal. And that is what we are focusing on here. Not the hype, not the crazy targets, not clickbait, just fundamentals, macro, technicals, and option structure. Because that's what actually moves the stocks. Guys, if you got value from this video, make sure you hit like and hit subscribe. In the next one, we're going to be taking a look at Nvidia after this move to the downside and see if we can set up a couple different option trades to make some money on this most recent news. This is Luke with the Option Bomb, and I will see you in the next one.